Hi everyone, it's Con Coloris here from Omega Financial Solutions. Today I'm joined by Andrew McKee, one of the co-founders of Elston, our research house, to share some valuable insights. We'll be discussing the current market environment, what's driving investment decisions right now, and how research shapes the strategies we recommend for our clients. Andrew brings a wealth of knowledge and expertise, and I'm looking forward to diving into the conversation with him. Let's get started. Andrew, thanks for coming down today. Let's start with my first question. What have been the key market trends and drivers year to date?
It's been actually quite an unusual period historically. If you look at the performance of our market, the Aussie market, last 12 months, very concentrated performance from our index. Only 65% of the total return for the index actually only came from 4 companies, which is very unusual. Say the ASX 100, that was CBA, NAB, Wesfarmers and Goodman Group, delivering 65% of the return, 35% of the return coming from the remainder, the 96 stocks in the 100. So very concentrated performance. Why is that? We've had a softer GDP environment. There's a bit of risk around that. So, and you've had the global trade war. So people have been looking at domestic safe havens and not really taking much risk in terms of their portfolio allocation. So any companies that maybe had some uncertainty or leverage to GDP haven't performed very well, and people have just been looking at domestically focused companies because of their defensive earnings and the like, or looking for growth companies that are growing outside of the economy, regardless of what the economy is doing. So, but I'd say the number one theme would be that concentration of performance, really isolated in a few names. Very unusual in a historic context as well. If you like isolated financials alone, you've never had a contribution to the performance of the index from one sector that's been so significant, and that's over 30 years of data. So I'd say that's probably the highlight.
Okay. All right. What do you expect to see in the markets over the next 12 months, and what factors will be the most influential?
Yeah, well, we think the number one factor will be interest rate cuts. So we've seen the Reserve Bank start to do that, start to cut rates, and we think there's further to go on rate cuts in Australia. So, GDP is still a bit soft and inflation's coming down, and so they've got room to cut rates now. And indications are it might be sort of sub 3% is where the cash rate ends up. You've also got the US, and it's likely that the Fed will also start cutting rates this month in September as well. So that's an overarching theme. So what we're looking at from a factor point of view are what companies or sectors that are what are the ones that are sensitive to rate cuts. So consumer spending, obviously consumer confidence has actually picked up. So companies that are sensitive to consumer spending, it might be things like property, for example. So a larger sort of property group like a Stockland, where you might see increased demand for new home constructions and the like. But it's that sensitivity to interest rate cuts that is what we're looking at, and we're doing the analysis right now of the companies we currently own that are sensitive to rate cuts that do well in a rate cut cycle, but also companies we don't own that do well in a rate cut cycle.
Yeah, good news for some of our home loan clients as well. All right, now my next question is a bit long one, so let me go through it.
Yeah.
There's an ongoing debate between active and passive investing, with evidence such as SPIVA reports on Australian equity showing that many active managers underperform their benchmarks after fees. At the same time, active managers often argue they can add value through risk management, downside protection, and capturing opportunities outside the index. How do you see the benefits of active management versus passive in this context, and how is our portfolio current position to manage the risks and take advantage of the opportunities in the Australian market?
Yeah. It's a fantastic question, and we probably need to get into it a little bit. So, for clients and investors, when you say passive, what is passive? So, what is an index? And all an index is a measure of the average performance. You want to watch the news at night. What did the share market do for the day? You need to measure what the average is of all the shares on the market. How did they perform on average? And you do that by building an index. And the convention in the industry is to build an index based on size. So the biggest companies get the biggest weighting in that index. But you can also build an index another way. You can build it, say, an equally weighted index, which is, say, the top 100, you give 1% to the top 100 stocks, adds up to 100%, and that gives you an average for the day as well. That's another way that you can build an index. But all an index is just a way of measuring average performance of all the shares for a day or a year or whatever. Now, the convention is that size. And unfortunately, Australia, for whatever reason, ends up with these big fish in little pond scenarios where we have these huge companies in Australia. And this is just in the top 100, very concentrated positions, and they change through time, but we've always seen this concentration. And so it's actually not a very good index. It's a quite a risky index. If we look at the top 10, that makes up in Australia 50% of the index. So every $1 million that you allocated to an index or a passive investment, 500,000 of that million goes just into 10 companies. Now, 5 of those companies are banks. You've got CBA, NAB, ANZ, and Westpac, and then you've got Macquarie, who's also a bank. And then the rest of it's materials. So 50% of the index in Australia is banking, or financials, and materials, mining. Now, that's a lot of risk you're taking on, a lot of concentration, because of what if something goes wrong? And, what if there's a housing crisis? What if the iron ore price, craters back to $80? And that's not how you're supposed to invest. The old rule of thumb is to diversify, not to have all your eggs in one basket, in that case in 2 baskets. You're supposed to diversify your money. And that's our view around risk. It's how you manage risk. At the moment, there's a lot of talk because the index has performed really well. It's been very concentrated performance in that top 10. The risk sort of conversation's gone away, and it's been focused on returns and the returns of the index. And we think the volume needs to be dialed up a little bit on the risk that we're seeing in the index at the moment. And that's the only way you can manage that is diversification. A good way of thinking it is, as your clients have absolute needs. They're going to retire. They need to build their wealth for retirement. And when they're retiring, they need to draw an income stream. And they need that income to grow over and above inflation over time. And one of the advantages of equities, of shares, of owning those businesses is the dividend grows over time and your wealth grows over time. But they're risky, they're higher returns, but you've got to manage that risk. And you manage risk typically by diversifying the portfolio. So we just don't think it's a true measure of how you manage risk when it comes to building a portfolio of businesses, which is ultimately what you own. If the index, for example, over the next 10 years did minus 5% a year, and we turned around and said, oh, we're the best managers, in Australia, we only did minus 3% a year for 10 years, none of your clients will be happy with that because they have absolute needs. They need money, their wealth to increase with inflation, and then their income to increase with inflation over time. So they have absolute return requirements, not relative return requirements. So we live in that world, we live in the absolute world and the risk management world where we want diversification of industry. We don't want to be too concentrated in any one business just in case something goes wrong. And if you put all your money in the top 10 like the index, it means you miss out on all those opportunities that are outside the top 10 as well. There's really great businesses. So it's a broader debate, and I think there's an element of understanding what makes up an index and why you're investing in shares at all and how you manage risk, and that's our view of the world. We look longer term and we look at positive returns, we're looking at absolute returns, driving growth, driving dividend, those sorts of things. That's what matters to us.
Okay. I think the point out of that is that a lot of people forget that the index, or don't see through that the index is so heavily weighted by our big banks and our miners.
Yep.
And that's the risk, isn't it?
It is, and I think you go around to other markets and other indices that are out there, and they're not as concentrated as ours. It's a bit more diversified, but ours is just not a good index to replicate because it's just too concentrated and too risky. And the way to think of it is, what if something goes wrong? So it's fine to be in banks until something goes wrong, like a GFC environment, and then that's a painful ride on the way down. So that's why you diversify, and it's basic investment. That's why you recommend that in terms of diversifying even out of Australian shares into international fixed income or property and the like. It's to reduce the risk and have a smoother ride over time, and it's reducing the risk of something going wrong.
Yeah,
and
that's
the impact on people's
time
capital
as well. We're investing for the long term here.
Yep.
All right. Now, we've touched on this, but I'll just ask it. How is the portfolio current position to manage risk and capture opportunities?
Yeah, well, look, it's probably one of the best times actually for us, because we know where the opportunity isn't. So we know the opportunity is not in those top 10 names. And the reason for that is that they're really overvalued at the moment. They're overvalued and they actually don't have a lot of earnings growth. And when you're buying a business, and shares on the market are just businesses at the end of the day, and you're the owner of those businesses. You want profit growth and dividend growth, and you don't want to overpay for that business, because you won't have the returns if you overpay for any asset. So in that top 10, we just don't see the earnings growth, and you're overpaying. It's just they're really, really expensive, even though they might be great businesses. So we don't see a lot of opportunity there, and that also means that there's a huge amount of opportunity elsewhere, because all the money has been flowing there. It hasn't been flowing into other names. So if we think of those interest rate cuts I spoke about earlier, what companies are outside the top 10 that are sensitive to those rate cuts and do well in that environment? How do you leverage the opportunity to economic recovery as you come through, as interest rates are cut and they stimulate the economy? So that's where we're positioned. And if you look at the overall portfolio, on average, we have more diversification in the index. We have better valuation than the index. And we have more earnings growth in the index. And we're sort of sport for choice outside the top 10. So for us, it's a really good period.
Yeah. Can you share a stock story with us about a certain stock that has been a strong contributor this year?
Mm-hmm. I picked Challenger. A lot of people would know the Challenger name for annuities. Challenger's up 40% over the last 12 months. The reason we bought that is we looked at companies that would benefit from higher interest rates, when the rates were going up. And a Challenger is a beneficiary of that because of the pricing of annuities. If you're going to lock your money up for an annuity, for lifetime or for 15 years, and interest rates are 1%, you're getting 1% return for 15 years. That's reasonably unattractive. No one's going to do that. But if interest rates go up and suddenly you're getting 5%, 10% on that annuity, they're a lot more attractive, guaranteed returns. And so we originally looked at that as saying, well, what companies would benefit? And clearly Challenger would benefit from that. We also see the fact that they're dominant market position. They're 90% of the annuity market in Australia. And then the third thing, you've got this demographic shift where you've got a huge baby boomer retirement set coming through, and they all need some form of income security. When you go to, you no longer have an income, you want to make sure you can guarantee at least a subset of your income through time. So we saw that there would be huge demand for lifetime income products like annuities. And, that sort of played out. What we didn't anticipate is government has come in and actually supported this as well. And APRA's come in to support it. So the problem with the annuity business is quite capital intensive. If I guarantee you an income, I've got to keep the assets aside to make sure that I can pay that annuity over 15 years. APRA's watering down those capital requirements, and it'll make the annuity market a lot more attractive and much higher returning for Challenger as well. So, dominant market position, demographics, and then now you've got sort of government support as well. We think that business is actually primed to continue to do well.
And then also following on from that, are there any holdings that you expect to outperform over the next 12 months? And what's the investment thesis behind them?
Yeah, one we've added recently is Seek. Most people would be aware of Seek and what they do, but job ads are obviously dominant in Australia, but they also have operations in Asia as well. And we like that for two reasons. One, they've done a lot of really great work over the last few years to simplify that business. All their technology has been put onto one platform, both for the Asian operations and the Australian operations. That's allowed them to reduce their operating costs significantly. They've been investing heavily in technology to improve the functionality, both for hirers, but also for candidates. There's a lot of AI in that, so the AI will write the ad for you if you're looking for a new employee, and also do a lot of screening of potential candidates to make sure you've got good matching. That's flown through to increased market share, so more employers are using Seek, and also they're finding the value of putting an ad up there on Seek because of the matching quality is better. So they've been able to increase prices. So gaining market share, increasing prices, and lowering costs has led to good profit growth. The one thing that hasn't been there, and that's been private sector job growth. The job growth in Australia has been government, has been public sector job growth. Small businesses have been reasonably cautious around on hiring. And so interest rate sensitivity, when rates are cut, it stimulates the economy and it can stimulate employment. And so we think that you'll see improved job numbers with Seek as well. And given the other things like pricing, strong pricing growth and low costs, plus an increase in ad volumes, that stock could do really well this year in terms of earnings growth, on top of whatever they've done to date. And that's that sensitivity to interest rates coming through.
Yeah. Well, we recently went through the hiring process using Seek, and we experienced their AI, and it made the process easier. So I can attest to the benefits of that.
There you go.
All right. Well, thank you for that.
No,
thank you for coming in today.
Yeah, I appreciate you getting me along, and been great to have a chat. And I also wanted to say to all your clients, thank you for their ongoing support on behalf of all the Elston team. You sort of see me, but there's 100 other people at Elston, and working diligently away in the background. So, I just wanted to, on their behalf, say thank you very much to your clients for their support as well.
Yeah, thank you.